Nissan Motor Company enters the approach to 2026 under a cloud of structural financial stress that has not meaningfully lifted since its crisis years in the late 2010s. Despite repeated public narratives of turnaround and renewed discipline, the underlying mechanics of the balance sheet tell a far harsher story. Debt remains elevated. Cash generation is inconsistent. Capital allocation has repeatedly failed to produce durable returns. When examined through a forensic lens, Nissan does not resemble a company on a stable recovery path, but rather a manufacturer struggling to arrest long-term erosion in competitiveness and financial resilience. The core problem begins with leverage. Nissan still carries a heavy automotive net debt position when compared with peers that have successfully deleveraged since the pandemic era. While headline liquidity figures often appear adequate, they are heavily dependent on continued access to capital markets and on captive finance operations that are themselves exposed to credit cycle risk. A meaningful portion of Nissan's liquidity is not excess cash, but functional liquidity tied to receivables and dealer financing. In a downturn or credit tightening scenario, this liquidity can evaporate far faster than management projections imply. Operating cash flow has been volatile, and in several recent periods, it has been disappointingly weak relative to revenue scale. Margins remain thin across key regions, particularly in North America and parts of Asia, where incentive pressure and inventory misalignment persist. Nissan lacks the pricing power enjoyed by stronger brands and has historically relied on volume to absorb fixed costs. That model is now structurally impaired. Global auto demand growth is slowing, while competition in the mass market intensifies. Volume without margin no longer covers the cost of capital. The electric vehicle transition has further strained resources. Nissan was once perceived as an early leader because of the Leaf. That advantage has been squandered. Subsequent electric programs have required large capital outlays, yet they have not delivered category leadership or superior profitability. Battery sourcing costs remain high. Platform fragmentation persists. Meanwhile, competitors with deeper pockets or stronger scale economics are compressing prices. The result is a classic investment trap. Nissan must continue spending to remain relevant, yet each incremental dollar of investment carries a low probability of earning an adequate return. Capital allocation discipline remains questionable. Shareholder returns have been minimal and inconsistent, which, in isolation, might be defensible during a turnaround. However, retained earnings have not translated into a materially stronger balance sheet. Asset sales and restructuring actions have provided temporary relief, but they have not produced a reset. Fixed cost absorption remains fragile because of underutilized capacity in several plants. Closing or repurposing facilities encounters political and social resistance, especially in Japan, and that resistance further delays decisive action. The alliance structure adds another layer of complexity and risk. While cooperation can reduce costs in theory, it also constrains strategic freedom. Platform sharing and joint purchasing only deliver benefits if execution is flawless and incentives are aligned. Recent history suggests otherwise. Internal frictions dilute accountability and slow response times. In an industry where speed and clarity increasingly determine survival, this is a serious handicap. Residual values of Nissan vehicles have trended weaker than those of key rivals. This is not merely a branding issue. It directly impacts the economics of leasing and captive finance operations. Lower residuals require higher incentives and higher credit support, which in turn pressure margins and raise credit risk. A feedback loop emerges where weak brand perception drives financial deterioration, which further erodes brand trust. Please subscribe to our channel. We want to hit 1,000 subscribers this week. Dealer networks reflect this stress. In several markets, dealers have reduced exposure to the brand or demanded stronger incentives to carry inventory. Floor plan financing costs have risen. Aging models linger longer on lots. This is not an abstract metric. Dealer health is an early warning signal in automotive failures, and Nissan dealers increasingly display defensive behavior rather than expansionary confidence. Credit ratings agencies continue to view Nissan with caution. While not yet at deep junk levels, the outlook remains fragile. Any sustained earnings miss or macro shock could trigger downgrades that materially raise borrowing costs. Given the scale of refinancing needs over the next several years, this risk is not theoretical. Higher interest expense would directly crowd out investment and further weaken competitiveness. Perhaps most concerning is the absence of a credible margin expansion narrative. Cost-cutting alone cannot offset structural disadvantages indefinitely. Without a clear path to sustainably higher returns on invested capital, Nissan remains exposed to gradual decline rather than sudden collapse. Such declines are often more dangerous because they erode optionality year after year until strategic choices narrow to unpleasant extremes. For consumers, the risks embedded in Nissan's financial health translate into tangible consequences that deserve sober consideration. Vehicle buyers often underestimate how corporate balance sheet stress can affect the ownership experience. History shows that brands under prolonged financial strain frequently compromise in areas that directly touch the consumer long before any formal insolvency event occurs. Warranty exposure is a primary concern. While existing warranties are legally binding, their practical value depends on the manufacturer's ability to honor claims efficiently. Cost containment pressure can lead to slower approvals, narrower interpretations of coverage, and increased friction at the dealer level. This does not require bankruptcy. It merely requires management incentives to conserve cash. Consumers may experience longer repair times, more disputes, and reduced goodwill support. Parts availability is another risk. As manufacturers tighten working capital, they reduce inventory buffers. Global supply chains are already fragile. A financially constrained automaker has less flexibility to expedite shipments or dual-source components. This can translate into extended downtime for repairs, especially for newer electric and hybrid models with specialized components. Resale value risk should not be ignored. Vehicles from financially weaker brands tend to depreciate faster as market perception adjusts. This affects both private owners and fleet buyers. Higher depreciation raises total cost of ownership and can trap consumers in negative equity situations, particularly if incentives were used to facilitate the initial sale. Nissan's current residual trends already point in this direction. Dealer stability matters as well. If dealers exit the network or consolidate, service coverage becomes thinner. Rural and secondary markets are typically hit first. Consumers may need to travel farther for authorized service or face reduced competition among dealers, which can increase maintenance costs. Software support and over-the-air update commitments for newer vehicles introduce an additional layer of dependency. Long-term software maintenance requires sustained investment. A company under financial pressure may prioritize new product launches over legacy software updates. This can leave owners with aging digital systems that degrade functionality and security over time. In extreme scenarios, prolonged financial weakness can force strategic retrenchment, such as withdrawal from certain markets or segments. Even without bankruptcy, such moves disrupt service ecosystems and resale dynamics. Consumers who plan to keep vehicles for extended periods should factor this risk into purchasing decisions. None of this implies that Nissan vehicles will suddenly become unusable or unsupported in the near term. The danger lies in gradual degradation of the ownership experience. Small compromises accumulate. What begins as slower service responses can evolve into diminished trust and lower satisfaction. By the time a brand reputation materially shifts, the financial damage is often already done. From a risk management perspective, consumers should approach Nissan purchases with heightened due diligence. Lease terms should be scrutinized for residual assumptions. Extended warranties should be evaluated carefully with attention to provider backing. Buyers should avoid stretching financing terms that rely on optimistic resale values. For investors and creditors, the signal is clearer. Nissan represents a case study in how legacy scale does not guarantee financial safety in a rapidly transforming industry. Without decisive balance sheet repair and a demonstrable improvement in return on capital, the probability distribution skews toward continued erosion rather than recovery. The automotive industry has little tolerance for prolonged mediocrity. Capital intensity is unforgiving. Technological cycles are accelerating. Companies that cannot self-fund innovation while maintaining financial resilience eventually face forced consolidation or restructuring. Nissan is not there yet, but the trajectory remains concerning. Approaching 2026, the question is no longer whether Nissan can survive another year. It is whether it can fundamentally alter its financial and operational profile before optionality runs out. For now, the evidence suggests elevated risk. Consumers and stakeholders would be wise to plan accordingly rather than assume stability by default. Please subscribe to our channel. We want to hit 1,000 subscribers this week.